Hi, good morning everyone. We're about to get started. So thank you all for coming. Thank you Bloomberg for hosting us, and thank you Startup.ML for organizing this event. We're going to have back-to-back speakers and some breaks for bio breaks and for food. And we're going to kick it off with Kai Giesecke.
Right. Well, thanks very much for the introduction. Thanks, Alshak, for organizing the event. Pleased to be here. So I'm going to explain how to use machine learning approaches for loan portfolio risk analytics and optimization. So this is a joint work with Justin Sirignano, Pasabwani, and Jerry Tsikalas. And Justin is in the audience, so save any hard questions for him. All right. So I think it's pretty obvious that there's many organizations that need to measure, manage delinquency and prepayment risk at both the loan and portfolio levels. So, just take a lender. Obviously, the lender is interested in loan level risk for the underwriting decision. But, what's also very important is to understand the risk at the entire loan book level. So, what's the risk from the firm's perspective? That's at most as important as understanding the risk at the loan level. Okay. If you look at an investor buying tranches in asset-backed securities that are backed by pools of loans, then for the investor, what matters is the cash flow on the on the tranche or on the pool level. It's not so much what the individual loans in the pool are doing. It's more about performance at the pool level, right? And same is true for rating agencies, obviously that need a rate. A structure, what matters most is performance at the pool level, not the individual loan level. All right, so more specifically, what are the typical questions that these organizations might be asking? So a lender might ask, what is the unexpected loss due to delinquencies, charge-offs, prepayments, and so on in my loan book over some pre-specified future period? How much risk capital do I need to support my lending activities? What's the exposure that I'm running if economic growth slows? So all of these types of questions can be answered by looking at the portfolio level probability distribution of loss from delinquencies, charge-offs, prepayments, and so on. And here's an example, a plot of that. So be interested in kind of like behavior that isn't really very much visible, but we're interested in kind of like the probabilities of various loss levels. Of course, the expected loss indicated here. We're interested in the quantile of the loss distribution. So, in other words, the value at risk and how much capital we need to reserve in order to, sustain a given level of loss. Right? So computing all of this is not completely trivial. I'll talk about the challenges later on. Okay, an investor might be asking, think of a marketplace loan investor. What's an optimal investment strategy in marketplace loans? So how do I construct a portfolio that's optimal in a certain sense? How do I backtest that portfolio? What's the risk that I'm running if I'm using that strategy going forward? Similarly, thinking of an investor in ABS tranches, what's important is the risk exposure at the tranche level. So the investor might be interested in something like this, the complete distribution of loss over the life of the tranche for different tranches. Here's the equity tranche, the junior tranche, the senior tranche. So they all have very different risk profiles. And what's interesting, what's of interest to the investor is what are the exact probabilities here? What are the loss levels that I should expect with certain probabilities over the life of the deal? Right? Again, generating these types of distributions is not completely trivial, and I'll talk about the issues. Someone securitizing a structure, an ABS structure, might be interested in picking an optimal set of loans for a pool backing a certain ABS, so that investors' return is maximized while the different tranches, garner certain ratings, right? So this is also a non-trivial problem. How do you package a deal so as to maximize returns for the different tranche investors while getting a certain target rating, right? It's often of interest to issue ABS with certain target ratings, and so the question is, well, how do you set up these pools so that you get these ratings at the same time the investors get the full benefit? Okay, as I mentioned, why are these problems challenging? So, one factor is size. The portfolios might be very large, so there might be dozens or even millions of loans in these pools. So it's a very high-dimensional problem. The problem is also high-dimensional because the features for each loan might be many features, right? So there might be hundreds or even thousands of features for each individual loan in the pool. So this is another source of high dimensionality in this setting. When it comes to data, in some asset classes, there's a ton of data available that you can analyze, look at mortgage markets, so that there really is long history, covering, millions and millions of loans. So there's lots of historical data, and if you're constructing models, then dealing with large data sets, poses challenges. States, there's not just good and bad, there's a lot between good and bad. So you can look at 30 days past due, 60 days past due, 90 days plus past due, charge off, delinquency, foreclosure, forbearance, and so on and so forth. So, there's typically multiple states that need to be tracked and modeled. Another point that's very important, I'll come back to that, is correlations. So, if you're taking this portfolio level perspective, right, what matters the most is not loan level risk, but how the loans, are correlated. So in other words, what's the tendency of the individual assets to move together, let's say with changes in the economy. Okay, so capturing these loan-to-loan correlations is very central to portfolio risk analytics and optimization. Dynamics are important, so it's not typically a static problem, right? So you're not just interested in how things develop over some fixed period of time. You're interested in how things evolve over several future time periods, right? So you're interested in the term structure of risk and how that unfolds. And all of that needs to be done in real time, right? So you need to click the button and you need to have the results, right? So that's all very challenging, and I'm going to present a bunch of tools that we developed over the past couple of years that address most, if not all, of these challenges. So we have a risk classifier that is designed to measure loan level risk. We have a pool analyzer tool that quantifies pool level risk, so going from the loan level to the pool level, factoring in all the correlations between individual positions. And we also have a tool for portfolio optimization. So if you are trying to optimize a portfolio subject to certain constraints that are dependent on the context of the problem. So I'll go through each of these tools in the rest of the presentation. So here's the overview. So the risk classifier kind of churns out probabilities of various future transitions that you could see. So this is not just a good bad thing. It's really churning out probabilities of transitions over any future time period, and we're taking into account correlation between these individual loans. Right. The pool analyzer then takes this or builds upon that classification engine to generate the full distribution of losses or profits. Yeah, we should be talking about profits, not losses, right? So it generates the full distribution of profits or losses over any future time period, taking account of these correlations, right? Once you have that distribution, then you can get also the risk statistics, expected losses, unexpected losses, quantiles, whatnot, everything that's of interest to lenders, investors, regulators, raters, and so on and so forth, right? Building on top of that is a portfolio optimizer, which allows you to optimize or select a set or loans according to a certain objective that you might pick and certain constraints that might be relevant in the context that you're working in. All right, so what's under the hood? And here's the connection, of course, to this conference. We are building dynamic machine learning models of loan delinquency and prepayment in a pool of capital N loans. So throughout my talk, the capital N here, the capital N, okay, it's barely visible, but the capital N is, stands for the number of loans in the pool, okay? So that's an important quantity because in order to build these other applications, the pool analyzer and the pool optimizer, we are going to perform some asymptotic analysis. So we're looking at the behavior of these models as a number of loans in the pool grows to infinity, right? So we're performing an asymptotic analysis, and the results of that allow us to construct a computationally efficient Monte Carlo approximation for the behavior of the entire pool. So, going from the loan level modeling to the dynamics of the pool, right? So we'll understand how the pool behaves over time, taking into account all the loan level dynamics and correlations. And we'll also show how to use this to construct asymptotically optimal portfolios for large-scale optimization of pools. Okay, so that's kind of like the big picture. And interrupt me, please, if you have any questions, right? Okay, so here's the is the big picture framework, looking at dynamic multi-state transition model, the conditional probability that the nth loan in the pool, right? So we have capital N loans in the pool. Now we're looking at one of them, the nth loan. Probability that this nth loan transitions from its state UNT at time level t, so thinking of current, 30 days late, 6 days late, prepaid, charged off, foreclosed, REO, forbearance, and so on and so forth, right? Entire selection of states that you fixed. The conditional probability to move from that state to a new state, level U, over the next time period, is a function h, okay, that's specified by a parameter theta that we're going to estimate. And that transition function takes as input, of course, the current state, a vector of loan level features that could be very long, okay? So think of FICO score, loan to value, debt to income, location, term of the loan, product type, and so on and so forth, right? So everything that you have in your loan performance data set that specifies kind of the product or the borrower level features goes into this YN vector. There's also going to be a vector V, and that's time varying. So this, the Y vector, the feature vector, is typically static, right? You get a snapshot of that when the loan is originated, and then that typically doesn't change over the life of the loan, right? So typically you're not getting updates on the FICO, right? Typically. In contrast to that, the V is a vector of time-varying risk factors that are common to all the guys in the pool, right? And that's supposed to model the national, regional, local economic and demographic conditions that describe the external environment in which a borrower lives. Okay, so these variables typically change over time, right? They're not fixed, but the economic environment changes over time. Okay. Third factor that we're including here, H, is a feedback factor. The way to think about this is that you also might want to include kind of like what the other guys in the pool are doing, right? So that might have an effect on the behavior of the nth guy, right? So, our example is kind of like in the mortgage space. So take a neighborhood and, you're modeling the risk of foreclosure on a particular, home borrower. Well, then that's going to be affected by what the what the borrowers in the neighborhood are doing. If there's lots of foreclosures in the neighborhood, then this has a negative effect on the other guys in the neighborhood. So that typically raises probabilities of delinquencies and foreclosures and so on, right? So this is something that we throw in here as well. Okay, this is kind of like a base model specification. We could extend to include like path dependence, meaning that we're not just looking at the current values here, right? We can look at the whole path. We can look at the total history of these factors, right? Not just the current values. That's possible too. We might also include latent factors, right? So the story is kind of like, okay, there is these hundreds of factors that you can observe and that are thought to have an influence on transition behavior, but there might also be other factors that you cannot observe, okay, that nevertheless have some influence on transition behavior of borrowers. So these are latent or frailty factors that could also be included, okay. All right, I'm only focusing here in the talk on the transitions themselves, but you could associate with each transition kind of another variable that specifies kind of like the economic impact of a transition. So from a lender's perspective, you could say, if someone transitions from 30 days late to foreclosure, right, then there's a certain loss associated with that event, right? And so you're not just interested in the transitions themselves, but also in the economic impact of those transitions, right? So this could also be put on top of the transitions, and I haven't included it here to keep it simple. Okay, so let's pause for a sec and look at this issue of correlation and how that comes into play. Okay, so we have essentially two mechanisms here that generate correlation between loans. One is that we have this dependence of the transition rate on this common economic factor V. So this is potentially long list of variables that change over time and describe the economic environment. And so any of these changes in the economic environment will impact all the guys in your pool, potentially to various degrees, but a priori there's these factors impact all the guys in the pool, and therefore you have correlated changes in transition probabilities, right? And that's one source of correlation here in this formulation, right? And the story is like this, right? Slowing economic growth affects all borrowers, and that will likely lead to more delinquencies in the pool, right? Other story, lower market interest rates have a positive effect for all guys in the pool, and they are likely to lead to more prepayments, right? So this is kind of like how to think about this. Then we have the second factor, right? This feedback term H. So, going back, right? So there's the V and there's the H. So past transitions are allowed to have a direct impact on current transitions, right? So this is kind of like a contagion idea here, right? If in your neighborhood, foreclosures start to occur, then, this has, a direct impact on the value of your home, making you more likely to move to delinquency, right? So that's the idea here. So there's two distinct mechanisms here for loan-to-loan correlation. So it's very important to capture that very, very carefully, because we're not only interested in assessing loan-level risk, we also want to assess pool-level risk, and that's where the correlation comes into play. Okay. So, back to the theme of the conference, the transition function H can be any machine learning model, right? So logistic regression, neural network, decision tree, etc. Anything under the sun could model the individual transitions. The parameter theta that's specifying the transition function can be fitted to historical loan performance data via maximum likelihood estimation. This is statistically the best way to approach the fitting problem. We have all the good asymptotic properties here. Implementation-wise, you would do the maximization typically with mini-batch gradient descent. You'd use some distributed computing environment. So we've used AWS EC2 to crank out the examples that I'm going to show. we'll also work with indicator variables to take account of missing data. So in practice, right, you might have lots of missing values in your features, right? So you need to take account of that somehow, and you could do this by including additional dummy variables to indicate that a value is missing. You might also play with penalty terms to avoid overfitting. So especially if you account for missing data, the dimensionality of the feature space might grow very quickly. So working with penalty terms is one way to address potential overfitting problems. Okay. So I'll show examples on the next slide. So last point, once you've fitted that model, you have a way to forecast, to predict multi-period transition behavior. So you can essentially kind of forecast how a guy moves over time through these different states, right? It's not just, is this guy going to go bad over the next month or the next 6 months or the next 30 years, right? It's kind of like how this guy moves through the different states that you have defined over time, over multiple future periods, right? It's not a single period thing. And that will address the future movements of your risk factors, right? So if you're modeling the influence of these economic, demographic, financial variables on the behavior of borrowers, you need to come up with a time series model for these variables, okay? And that feeds into your prediction, right? Because that will have an effect on how the guys in your pool move as economic, the economic environment changes over time, right? So, building this time series model is at least as important as building the machine learning model, right? Because the economic environment has so much impact on how borrowers behave. Okay, so here's a bunch of examples. So we have data on 120 million prime and subprime mortgages that originated across the U.S. between 1999 and 2014. 25 million of these are subprime mortgages, and the monthly transition matrix for these subprime mortgages is given here, right? So going back to the model, just to make this clear, right? We have a discrete time model. We chop up time into month in this case, right? And then we're looking at month-to-month transitions, right? So the transition matrix, naive estimate of the transition matrix, we're just looking at the frequency of transitions for those 25 million subprime mortgages. It is given here. So, if you are current at the beginning of the month, then there is a 93% chance that you are current at the end of the month, right? And there's a 4.7% probability that you move to 30 days late in a month, right? And there's a 2% probability that you're going to prepay. Okay, so this is just like labeling the data and looking at the naive transition probabilities, right? So similarly here, if you're 30 days late, then there's a 45% or the 30% probability that you move back to current. Okay, so this is the way you read this table here. And once you're real estate owned, that's an absorbing state, right? You can never come out of that. Once you paid off, that's the last row here, you're gonna, that's a terminal state. You can't move out of that, right? So that's the way you can read this table. Okay, so the states that we modeled here obviously is current, 30 days late, 60 days late, 90 days plus late, foreclosure, real estate owned, and paid off, right? Yes?
Two questions. The first one, is this the empirical kind of distribution, or is it actually from what the model is predicted?
No, this is no model. We're just looking at the transitions in the data set. No model yet.
And the second question I have is, if you go back to your slides that you were talking about the transition function, in this function, are you specifically capturing, so I just see the theoretically they make figure out what about moving?
Yeah, that's what I'm saying. You could include, the entire path observed back to 1850 of V if you wanted to, right?
I'm not saying you go that far, but did you try with different lengths?
We didn't try that yet, but it's, the framework allows for it, and
Yes and no, right? I mean, if you're assuming like a logistic function or something, you have to kind of explicitly factor correlations in. You can assume that's in the data.
No, you could, what you could do is you just make this problem Markovian if you wanted to by appending those past variables to the current state, right? You could do this, but there's no need to do it because we don't need that Markovian assumption anywhere, right? So it is, long story short, it is possible to include, past past behavior of these guys, not just the most recent one.
Completely, but the only point that I was trying to make, and maybe I'm not too sure about this, the MLE assumption gets violated when your errors start getting correlated from T minus 1 to D and T plus 1, right?
No, you can set it up in a way so that it doesn't. Yeah. So you can set it. Yeah, you can. Okay. Any other questions? Yep.
So when you're saying the HT is a function of how related this loan is to the performance of the other loans,
yep.
Are you estimating that function in the same universe as estimating the
yep.
function of probabilities, or are you doing it separately?
No, I mean this will be, there will be, parameters in that vector theta specifying h that are controlling the impact of the, what the other guys are doing on my loan, right? So that's all incorporated here in that abstract h function.
Also, for having a fixed term loan, is that a problem to treat this, to treat the transition matrix as something that could go on for longer than the term of the loan? Or does that...
No, the way you treat it is kind of like you have, you're looking at monthly transitions, and if you have, like, let's say a 5-year loan, a 5-year term loan, right? So you have 5 times 12 for observation, assuming that the guy doesn't prepay and doesn't default on the way, right? And so you have transition from, current to current to current to current, to 30 to 60, back to 60, back to 30, back to current, and then it's paid off at the end of the term, right? So that's the way you think about the data. So that's not, but there's no issue there.
Transition matrix, you could, if you were just treating it as that matrix there, you could stay in current for more than the length of the loan.
Well, if you apply it, this is just a naive estimate of the transition matrix. So you're just looking at, you're just throwing all the monthly transitions that you have into a pool, right? Then you're labeling them, and then you're just looking at the frequency, right? So there's no modeling going on here whatsoever. It's just a naive estimate of transition probabilities, right? Giving you an idea of kind of like what's the frequency of the transitions that you see in a data set, right? Right. If you were to apply it, of course, to a 5-year loan, right? Then there's only 60 periods to model, right? And this is the month-to-month transition matrix. It's the average over all the monthly transitions that we observe.
Thanks.
Okay.
Why are you including both like prime and subprime mortgages into this? I thought you were doing like all ABS subprime mortgages, but like in prime, obviously you have very different characteristics.
Yeah, so we have the 120 million prime and subprime, and we just for this example, we look just at the subprime. We have results on the way for the prime data set and the entire data set.
Okay, so just for this one, you're just doing.
Just for this example, we're looking at those 25 million, and I mean it's challenging to fit these models, to analyze these models. It's 120 million mortgages, right? That there is some challenges that you need to overcome, and we are working on them at this point, right? So
this transition matrix is just a subprime.
This is just subprime.
Prime and subprime.
Right. So no, the first point it was just saying, we have that data, and we just looked at the subpool of subprime mortgages, right? And there's a similar matrix here for prime mortgages that that we have, but I haven't included it here in the slides. Okay. Okay. So the static loan level features Y that we include, FICO, loan to value, initial interest rate, initial loan balance, buy down flag. So kind of like, did the guy pay any points up front? when taking out the loan. Type of mortgage, fixed rate, adjustable rate mortgage, etc. There's actually a long list of different types. There's like 10 plus different types. The type of property, documentation, loan channel purpose, days by payment answer. So there's a fairly long list of feature variables that we have that we throw in there. We also use a bunch of time varying common factors. This is the V. Housing prices, and the mortgage's zip code. Since we have the location of the mortgage, right, we pull in the housing prices that are relevant for that particular zip code, right? It's not kind of the national level housing prices. It's the zip code level housing price that gets pulled in there. It's the mortgage rates, unemployment rates, etc. So there's you can throw in whatever you think is having an influence on the timing of transitions here. In this baseline formulation, those are the factors that we include. And the mean field term, this is this feedback term, that is also responsible for the correlation of the loans. We take the default and prepayment rates and the mortgage's zip code, right? So we're looking at kind of like what's the rate, if I have a mortgage in a certain zip code, we're looking at the delinquency rate in that particular zip code. So that's going to be a factor for us too. Yeah, it's two questions. Yeah, you're first. Yeah.
What's kind of example of the function f mean field?
Right. So you could say you're pulling out the if the y let's look at the term here, right? So we're looking at the state and the features. The features include the zip code. We could look at just the rate of delinquencies or defaults or foreclosures or whatever you want in the loan's zip code, right? So the F would pull out, the element of Y that represents the zip code, and then a particular state that you're interested in, and you get the average.
But what's the transformation F that do to these two elements that you found?
No, you can, F is just, is set up in a way that you can pull out any information that you want. It could be an indicator, for example, right? An indicator, an element of Y equal to a given zip code and, state equal to 30 days late or foreclosure or something like that. So that's simple case, right? Yeah.
I guess two just quick questions. One is, looking at the common risk factors, one might hypothesize that there would be a lot of commonality in terms of movement. Any comment on that or concerns? And I guess the second thing I was thinking is that loan origination standards changed quite a bit between 1999 and 2014. And what would be the influence of those changes on how this model performs?
So we haven't, good point, right? So the second point, there's been some changes over this sample period. You could incorporate this by including a variable that, indicates kind of like the regime that you were in, if you wanted to. You could model this as a frailty, as a latent factor. You'd have a hidden type of model, right? We haven't done that yet, but it's a meaningful point. Regarding correlation between the V factors, so this collinearity is an issue that you can address. You can just look at the co-movement of those variables. There is some co-movement there, but they're not completely synchronized. Right? Especially as we are also looking at national level variables and zip code and state code, state level variables. So there is some, it's not completely synchronized, right? Okay. So, here's once you do this fitting, then here's a bunch of factors that are statistically and economically irrelevant. So this lag default rate and zip code is a highly significant predictor of foreclosure. So here we're looking at the variables that determine foreclosure, and we are using just a simple logistic regression model, right? So here, the lag default rate is highly significant. House price changes since origination obviously also important. Current interest rate minus original interest rate is important. It picks out kind of the effect on adjustable rate mortgages, right? So you start up with the teaser rate, and then the rate at the end of the fixed rate period, the rate is tied to a market rate, and the bigger that jump's going to be, the higher is the risk that you won't be able to make the loan payment and move at some point into foreclosure. So that's relevant. Outstanding balance, total days delinquent in the past, county unemployment, right? So here's one of the common variables that are important. So the higher the unemployment rate in the county in which the home is located, the homeowner lives, the larger is the probability of moving at some point into foreclosure. All right, so and then, obviously the list goes on and on. These are just the most important, the most influential factors. Of course, you would want to test the predictive performance of various models. So here we have logistic regression in blue, and we have the neural network here in red. It's slightly better for predicting outer sample 30 days delinquency within the next 6 months. So you could do these predictions for any time horizon, right? Here we've just chosen 6 months, and what we see here is that there isn't a significant difference here in performance for that particular event, and for that particular time horizon between logit and neural network. Okay. Yep.
What are the axes?
Oh, sorry. Yeah. I should explain that, right? So RC curve is a receiver operator characteristic. It's a standard tool to assess the predictive performance of a classification system, right? On the y-axis, you have the true positive, so the events that you correctly predicted, the fraction of events you correctly predicted, and these are the false alarms. So you raised the flag, but the event didn't happen, the fraction of those events. So the perfect model would be, kind of like a vertical line up there and then horizontal over there. So the closer you get to this, the better the performance of your model. The coin flip model would be just the diagonal. Right. Okay, one measure of predictive performance would be the area under the curve, which is just like the integral of what's down here. So that's a single scalar that represents performance. You want that to be high. Yeah, the closer to 1, the better, right? So here's a bunch of these AUCs for logistic regression and neural networks. Again, the 6-month time horizons. These are outer sample AUCs. They're pretty good. And you see not so much difference here between logistic regression and neural network for transitions to too current, 30 days late, 6 days late, 9 days late foreclosure or real estate owned, but there is a significant difference here when modeling prepayment, right? So you do get a significant boost in performance with the neural network for modeling prepayment. Okay. Yeah. Yeah, we use an L2 penalty term here. Yep.
I was going to ask, what kind of construction of a neural network are you using? Are you like single hidden layers?
No, there's 3 hidden layers. It's an ensemble network. How many neurons are we using? What's the latest?
We have 3 hidden layers. We use rectilinear neurons, and our layers are from like 20, 10, 10.
But it's kind of like work in progress. It's just like one example, set of results. We're still playing around with various configurations and various factors and performance measures and so on and so forth, right? That's just that we get to a certain point. I have to move quickly here to get to my stuff, right? So So what are you going to, now we've done this, loan level modeling, it's all nice, but ultimately we want to get to the pool level stuff, right? So how do we do this? Well, we could just use brute force simulation to simulate behavior of each individual guy in the pool over the time horizon of interest, right? But this is going to be fairly computationally intense if you're thinking of a pool with, 1 million loans, let's say, right? And you're looking at a 30-year time horizon, and you're modeling monthly transitions, right? So there's many transitions you need to simulate, many paths that you need to generate to get meaningful results using this Monte Carlo approach. And optimization certainly will be impractical, because if you imagine this sitting inside of an optimization routine and needs to be called many times, that will take like weeks. So you don't want to do this. So the trick that we have here, that's the kind of like the more scientific contribution that we have, is we have, we develop asymptotic approximation for large pools. They turn out to be highly accurate even for small pools, we'll show. They are very computationally efficient, orders of magnitude faster than the brute force Monte Carlo. And just to remind you, they do incorporate the detailed loan level feature and factor data. So we are not throwing out any data, right? So we take the full complexity of the loan level model and apply that approximation to get the pool level dynamics. Okay, so here's the result. So hopefully don't scare anyone. So the idea is fairly simple. So what we do is we're looking at, that's the key quantity here, that mu n. That's simply it represents the fraction of guys in the pool that are in a given state and have given features, right? So this kind of like completely specifies the behavior of the pool over time. So if you vary the little time t, right, you get you get the pool level behavior. Okay. Now this is a quantity that's fairly complex, right? It's very hard to estimate. But what we have is a theoretical result that's telling us, well, if we send the number of loans in the pool to infinity, well, then this quantity converges to a limit. That's the law of large numbers, okay? And we understand the limit, right? We have a very detailed understanding of that limiting quantity. And that's the equation that we have down here. So mu bar is that law of large number limit. It follows a certain equation that's given in terms of that fitted machine learning model, right? Okay, and that's it, right? So once we have fitted that, we have complete understanding of the pool level behavior of all the guys in the pool. Okay, that's kind of like the high level explanation here. So more intuitively, so this law of large number limit, the mu bar, that describes the behavior of an infinitely large pool of correlated loans, taking account of all the loan level detail that we modeled in step one. Okay, so we're not losing any of the detailed loan level data that we modeled earlier. Okay, so that limit, that's a kind of curious fact. The limit, the law of large number limit, is not deterministic, but it's random itself. Right, so it's not fixed. You're not converging to something fixed. You're converging to some random quantity, and the randomness comes from the dependence on this common factor. Right, so the v shows up here. Right, the v is the behavior of the economy. That's going to be random. Right, we don't know what that's going to be in the future. So the limit is going to be random as well. So think about it like this. I mean, it's kind of like, it's not the simple coin flip law of large numbers where you have independent, identically distributed coin flips. You have now coin flips, for, every flip is using a different coin, and the flips are correlated. And, a flip in the past can have influence on a flip in the future, right? That's at a high level the way you can think about this.
What's that little dy?
The dy, that would be the placeholder in order to get the quantity of interest. You'd have to integrate over the feature space here. So this is kind of like the differential. Think of it as the differential. Yeah. Okay. All right, so the uncertainty that comes from the loan level features completely diversifies in the limit. It's gone, right? All the little fluctuations, if you take things to the limit, they will be diversified, and there's only risk stemming from that, from the economic environment V that cannot be diversified, right? But once you kind of like roll the die and get this uncertainty resolved, the limit is again deterministic, and that's the way to compute the limit. So there's also a more refined result, which is a central limit theorem, which is telling you how the error between the true quantity and the law of large number behaves. So that scaled error is also converging to a random quantity that we completely understand, and that's the key kind of to develop this second order approximation. So we know that the fraction of guys in the pool that are on state U at time little t and have features given by little y, that fraction can be approximated by the law of large number limit and the fluctuation limit here, right? And so the goal is, instead of computing the left-hand side, which is very hard, can only be done by brute force Monte Carlo, which takes weeks, okay? We compute the right-hand side, the approximation, which is very quick and very accurate. That's kind of the moral of the story here, right? And so the right-hand side, this approximation covers all possible states and transitions, right? It's valid for any time t, so it's completely dynamic. So it's telling you how things behave dynamically over time, okay? The approximation addresses loan-to-loan correlation and all the detailed loan-level data. And it gives you the full, distribution of profit and loss for large pools, or for pools of any size, any meaningful size, and even for, tranches that are backed by these pools. All right, so here's just a few figures, again, for the subprime pool. So to demonstrate the accuracy of this approximation, we're looking at the actual loss distribution here for a randomly drawn pool of 500 borrowers, okay? And the approximation is in dashed here. And you see for a pool of 500 guys, this is fairly accurate. If you move to a pool of 1,000 guys, it becomes more accurate. 2,500 guys, you're more accurate, and as a 5,000 names, it's fairly accurate. Okay, so that's what the result suggests, right? If you move things out to infinity, then the approximation becomes more and more accurate, right? Okay, here's the comparison for 10 actual subprime MBS pools. So we have data on actual MBS deals and subprime MBS deals, and we're looking here at the true distribution of loss. So this is the loss due to default. So that's default meaning moving into foreclosure or real estate owned. And here we have the x-axis will be probabilities. You see that the risks of these deals are fairly different here. All subprime pools, and the approximation again in dashed is doing a very, very good job in matching those distributions. So these deals have between 5,000 and 10,000 loans in them, right? Horizon is 1 year. Okay, there's also a lot of accuracy in the tails that you don't see here, right? The tail is what's of interest from a risk management perspective, right? It's not just the center of the distribution. You want to understand what the tail looks like. So if you're looking at the prediction for quantiles, then that turns out to be very accurate. So here we're looking at the distribution of the arrow in the tail in the 99% quantile value at risk, and how that unfolds. So there's a distribution of errors, and the errors are below 0.6% for smaller deals, and below let's say mostly below 0.5% for bigger deals. So not only do we have accuracy in the center of the distribution, but also in the tail of the distribution, which is the important quantity from a risk management perspective. Now, computational times, we're doing pretty well. So if you compare against brute force simulation, so moving from a portfolio of 1,000 names to one with 10 million names, right, we have a clear performance advantage here. Our approximation doesn't depend on the number of loans in the pool, right? It's always going to be 2.7 seconds. Whereas here, of course, the more names we have to simulate, the longer it's going to take, okay? So this is just laptop, right? To give you an indication of what you can expect, just in terms of seeing the relation. So this is for 1 year horizon. If you look at the mortgage space, right, 30-year deals in the prime sector are very common. So if you're looking at the 30-year time horizon, the simulation becomes, very time-consuming, right? And still, we have this very significant time advantage here using our approximation. Okay, now optimization is another matter, right? And I have like 5 minutes left, so let me rush through this. Optimization of pools is very difficult, right? Because you're facing a high-dimensional nonlinear integer program. It's an integer program because you can only choose 0 or 1 for a loan, right? You can't buy any fraction of a loan, so it's yes or no. Okay, it's high-dimensional because the pools tend to be large. It's computationally difficult because the objective and constraint functions are typically highly nonlinear and are computationally expensive to compute. Okay, so our approach is again this asymptotics, right? Use the asymptotics to approximate the objective and constraint, then solve the approximate program, and show that the solution of the approximate program actually converges to the true solution as you increase the number of names, right? So you have a performance guarantee or an optimality guarantee. So what's the problem, right? So the portfolio is simply a choice of loans from the feature set, right? Each loan has a set of features, and by picking a loan, you're picking essentially a feature out of a feature space. Okay. What we want to do is, at a high level, we wish to optimize some well-chosen performance measure that's a function of the, as a function of the pool behavior and the macro state. And we have constraints. So, for example, we might want to, minimize the expected value of that performance measure such that certain constraints are satisfied. So the objective could, for example, be the variance of the profit and loss in the pool. Could be some other risk measure of, for example, value at risk. It could be the investor's expected utility of final wealth, or it could be the distance between the distribution of the return and some target distribution for the return, right? So this is a pretty flexible way to formulate this problem here. The first constraint could describe an expected return threshold, right? So you might say, I want to minimize risk subject to producing a return above a certain pre-specified threshold. That would be a mean variance type formulation, right? A second constraint might model, various requirements that you face in practice. So, for example, you might say, I want to do this mean variance thing, but I also want the pool to have a certain average FICO score, right? Or, I have certain supply limits. There's only so many loans in this category that I can pick from, so I need to respect certain supply constraints, okay? So now that's the key slide here, and then I'm essentially done. In order to make this tractable, so this is not tractable for the reasons I explained earlier. To make this tractable, we are replacing our performance measure, which shows up in the objective and the constraints, by the limiting performance measure. Okay, that's the one obtained by replacing the true, the true distribution of all the states and features in the pool by the approximate one, coming out of the law of large number and central limit theorems. Okay, and then solving the approximate program. Okay, so this is, this reduces computational effort by orders of magnitude, because instead of solving that nonlinear integer program, we optimize just over a single function. right? So we transformed the original optimization problem into one that's, it's a lot simpler to address, okay? And all of that, again, addresses the full loan-to-loan correlations, all the feature variables, no information is lost, okay? And here's a performance guarantee, so, the solution of that approximate program does converge to the solution of the true problem, right, as the number of loans grows to infinity. Okay, here's some examples. So looking again at mortgages, here we're using a pool of 1,000 prime mortgages, and we want to select 250 of them so as to hit an expected target return of 1% and minimize the variance of the return. Right? And the return takes account of the exact timing of the cash flows. Right? So, as an amortization structure, if there is, if you move into delinquency, there is an event. If you move in 6 days past due, and so on and so forth, right? So there's kind of like, you keep track of all the possible events and the financial impact that those events have. That all goes into the return, right? So that's the way it looks, right? So the blue crosses here represent those 1,000 loans. In the interest rate and prepayment score space, and the optimization picks, the loans that are in square here, and the ones in red are the ones, but is the difference between our asymptotically optimal portfolio and the true integer program. And so there's 18 out of 1,000 loans where you have a difference here. So that's the arrow, so to speak, due to the optimization. Okay, but what you're getting is 2 seconds of optimization versus our optimization versus 1 hour and 28 minutes using the best-in-class nonlinear integer program solver, right? So there's again a very significant speed up that you have. Similar, if you pick 500 from 1,000, it looks like this. The error rate is even smaller. It's 12 out of 1,000. Subprime space, again, interest rate versus default score. And here we're picking the log optimal portfolio. So we are choosing the portfolio that maximizes the expected log value of the pool at the horizon, at the 15-year horizon. So it's a buy and hold investment. You want to maximize the log utility from terminal wealth that you get from holding the pool. That's going to take 34 seconds versus 39 minutes. And error rate is essentially small too. Okay, you can scale this up. We have 100,000 subprime mortgages, right? And want to pick 25,000 of them. It works in 30 seconds, and the integer program is totally intractable. So if you go beyond a few thousand loans in the pool, the best-in-class integer program solvers will be intractable. Okay, so you have no way to even compute the true solution, right? Anyway, so that's giving you an idea of what's going on. So to summarize, we've essentially developed a way to use machine learning approaches to solve these challenging loan portfolio risk analytics and optimization problems. So we start out with a dynamic multi-state machine learning model for loan risk, delinquency, prepayment, foreclosure, etc. And on top of that, we built this asymptotic approximation engine that lets us, approximate the dynamics of pool level behavior, and also lets us, pick loans from the pool optimally, even though the pools are very large. So the numerical test that I showed you used actual mortgage data. I should say that the machinery here is applicable to any type of loan, right? So we made experiments with small business loans and consumer loans, and we focused a lot on the mortgage space because we had this very large data set that we played with. But similar results are available for other loan asset classes. Yeah, so we have a few more questions, I hope, for a few more minutes for questions, I hope. Yep.
So if you're in the scenario where every loan needs to be allocated to a portfolio, are you able to do this recursively?
No, you could. You mean you have 1,000 loans and you need to pick 1,000 of these?
You have, say, 1,000 loans, and you need to put all 1,000 of those each into one of 10 portfolios. Could you find the first portfolio, which is optimal in some sense, and then find the next one and do this so that every...
Yeah, I think you can set up. It's related to the problem if you say you want to structure a pool backing an asset-backed security where you have different tranches, right? And then you'd say you want to optimize the pool so that the deal is optimal for each of the different tranche investors while garnering a certain rating. It's kind of related. It's not exactly a problem that you sketched out, but it's related to this, and that we've done. I don't have it in a slide, but we have it in the papers. Yeah. Yep.
Where did you get the loan level data?
The one that we have here is from CoreLogic.
I saw as auto sample test. They showed that between 1,000 for a year.
Yeah.
Have you tried any tests for the stability of the structural changes? Let's say
not yet.
Rated like 2002 to 2006, and then tested 2008, 2009.
Yeah, totally a good point. So no, we haven't done those tests. As I said, we are working hard to deal with the entire data set of 120 plus million mortgages, which is significantly challenging, and we haven't run those types of tests, but we will at some point. Yeah. Yep.
I guess my question is, would this model be able to pick up these time periods where the nature of the loan kind of material changes?
You could, right? If you insert variables that kind of like track these regime changes, and the fitting shows that they are significant, you could pick this out. Right? You could work with kind of like hidden variables and then have a filtering problem, determine the unobserved states and all that stuff. You could build that on top of this. We haven't done that yet, but it's possible.
Sorry, guys. Our next speaker is here, so we can hold questions for the break.
Yeah, so I'm going to be around, so plenty of opportunity for questions. Thank you.
Thank you very much.